Okay, you have entered the cauldron. Good afternoon, everybody. So it's just gone 1 o'clock. We normally wait just until a minute or two past 1 until we start the session. So not as many here today, but hopefully you will learn something. You'll take it away, and you can disseminate it then among your friends and colleagues, and see if they want to watch a recording of the webinar. So anyway, let's get cracking. My name's Mark Solon. I'm the managing director of Symmetry Financial. If you've attended sessions before, you'll be familiar with what we've been doing. Just about us, we're 3 years old next month. Symmetry, I set up Symmetry when I exited a previous company I was involved in. When we were there, we were the mortgage broker of the year. The staff that ran the mortgage division came at me to Symmetry Financial. So I'm able to blow that trumpet, and we've actually got 9 full-time staff now. So we hired another lady last week. And just in relation to the service, so I get asked this actually every time somebody comes from one of these webinars. So the facility for a complimentary consultation is available for everybody that listens in to these webinars. So what I mean by that is, if you want to book consultation, which I'm going to explain at the end, on our website, put in the details. It is complimentary, so that means there's no fee. Okay, so why is that? Because it's part of the service or part of the package. After the initial consultation, if something comes about from it, there may well be a fee. There might be some advice we give you. There might be a product you invest in, or a service, or something you avail of through Symmetry Financial. God only knows where that will lead us. But just to be clear, that the complimentary meeting option or offer is complimentary. Okay, so it's on our website as well. It's part of our terms of business and part of our schedule of fees. So you can read about it on our website as well. But I do get asked it quite a lot, so I just want to box it off here at the start. So what have we talked about in this webinar? Basically back since October, we've talked in depth about mortgages. We've talked about the mortgage process, what banks look for. We've looked at investing in property. We've looked at investing in property as an individual, as a company, as a pension. I did quite a bit on budgeting, the whole concept of money management. I talked about tax, which had really good feedback. Again, we're not a tax advisory company. We partner with a company. It's all on that webinar. It's all on the slides from that presentation, if anybody cares to take a look. We talked about insurances, financial protection. We talked about credit history and the role credit history plays in borrowing money in Ireland. And then last week we did a financial independence part 1. And this afternoon, we're going to do financial independence part 2. And this came about from feedback, questions we're getting, and obviously trying to be innovative and bring new topics to the table. So what I would say to anybody listening is, if there is a topic or something you'd like us to zone in on, financial related, and if I think we have the skill set to cover it, fire it over to the lads, to Dylan in particular there, and we can put together notes and do something on it for you. Okay. So what are we going to cover today? Just a recap of what we did last week. Going to use a few case studies, talk about cryptocurrency, going to talk about asset growth. It kind of all rolls into the one thing though, and timeframes to achieve independence, and then the 4% rule, or is it 8%? Okay, so again, just giving you a snapshot. Some of this is of my own opinion. Some of this information has come from, it's very hard to create new information in the financial services world, because financial services and financial planning and financial investing has been around for centuries, basically. So, and history does tend to repeat itself. But in terms of opinions and things, some of it will be of my own. So do with that what you will. So what did we talk about last week or last fortnight? We talked about the idea between, so how you become financially independent. We talked about you accumulate assets or you cut your reductions. And it's trying to find a happy medium between both, because it's a combination of both, which leads you to the path of financial independence. It's the concept of active income versus the passive income. So what you're trying to do is use your active income, which is your salaries, to generate passive income, which is investment income, rental income, dividend income, coupon income from bonds. If you have a farm, it could be headage. If you have forestry, it could be payments in relation to the forestry. So it could be anything that you're earning money while you're not working. Okay. Caveat emptor, we spoke about in relation to educating yourself, not to rely on others. So here I am, a financial professional. This is what I do day in, day out, 5 to 7 meetings a day, most days. And I'm talking to you about educating yourself. That's actually where we start with our clients, because it actually makes our job an awful lot easier if the person or persons we're talking to have an understanding or a grounding in what we're trying to help them achieve. Okay, so don't just trust the us's of the world. Okay, identify your behavior, identify how you view money. So we talked about the hoarder, the spender, the accumulator, the speculator, the worrier. So we spoke about that. So identifying what your personality is and how you approach money. Goodness me, already this week I've dealt with every one of those personalities. I mean, it's just our job. And I dealt with a lady who is an avoider of the highest standard, highest skill, amazing avoider, divorced. And it's the first time in my financial career, and we run quietly, we run a divorce and separation service where solicitors bring clients to us for financial advice in that scenario. And it's the first time I've dealt with one, or one has been referred on to me, where the female in the conversation has been absolutely taken to the cleaners, and completely inaccurate. So I opened her eyes to that yesterday or Monday it was, I think. I opened her eyes to it, and she needs to get her ass off the couch and start taking action, is basically what it was. So, and that's up to her. I can lead her so far, but she has to take action. And based on the emails that have been coming from her in the last 24 hours, it looks like she will. That's fee business for us. But in relation to how I structure that with her, we're going to put her on a path, ultimately to hope with an ultimate goal to try and be financially free when she gets to retirement, because on her current path there isn't a single hope in hell that she's going to be able to retire financially comfortable. So we talked about budgeting, we talked about tracking spending, we talked about having goals. It is important. It's super important to have goals. Geez, I mean, how many financial goals do I have? How many goals have I had in the past that I no longer have now? How have they changed? So have a plan, but plan on the plans changing. Okay. So make sure that you're adaptable in relation to what your goals are. Don't be rigid. Don't be, don't be static in relation to what you're hoping to achieve, and just move with the punches then. Okay. So things come in from the side that you wouldn't have anticipated, or things occur that you mightn't have expected. So a surprise child, a divorce, a death, a financial emergency in the family. So there's many things that happen that put the kibosh on our financial plans. Okay, so you have to be flexible in terms of what you're doing. So, and that all leads to financial independence, not taking on too much debt, saving. So save because you can save. Don't save with a goal in mind. So people always say, I have to, why am I saving? Rainy day fund, want to buy a car, want to retire. Just save. Okay, so that is simply the best advice. And then when you're saving, now we can explore what you do with that money. So you're looking to accumulate assets over time, whether that's stocks, whether that's property, whether that's alternative investments. And I have in there about cryptocurrency, which we'll talk briefly about at the end. It could be dividend, it could be government bonds, it could be, as I said, forestry, it could be alternative energy. It entirely is driven by your appetite for risk, which again we'll be talking about as we go along here. And then you have to let time do its thing. Okay, so a lot of people are impatient when it comes to their finances. They can't think 3 years ahead, never mind 30 years ahead. It's just a human inability to try and understand the concept of compound interest. How we try to get people to put time into context is if you try and say, okay, if I'm going to give you a 10-year time frame on this, okay, so I'm saying in 2021, we're going to take a 10-year view on this investment, or 15-year view on this property investment. What we then say is, think back to 2011. Okay, so where were you in 2011, and how quickly does it feel that time has passed? That's as good as we can do in terms of trying to get you to understand how time works when it comes to investing, because it does pass. It passes the same for everybody. It's the one thing that we all have in common, is we all have the same amount of time. When it comes to investing, same principle applies. We all have the same amount of time. It's what we do with it. Okay, and it is probably the most important part of it. And then the unit cost averaging, which allows the average individual, for better and worse, you can read about this, you'll Google it, you'll YouTube it, there'll be videos about it, there's books written about it, good and bad. Our opinion on it is it gets you active, it gets you involved, and for that reason we like it. Okay, so, and I covered it in detail the last session. So getting into a few case studies. So I'm going to look at a couple of examples of how financial independence occurs for different people. So first one, you may or may not have heard of Ronald Reid. If you have, brilliant, because it tells me that you're engaged from a financial perspective. The likelihood is you've never heard of Ronald Reid. Ronald Reid was a janitor. Ronald Reid was a gas, as they call it in America, was a gas pump attendant. That's pretty much what he did his entire career. He didn't run multi-million-dollar businesses. He didn't have a property portfolio. What he did have, a stock portfolio. So over his entire working career, the man invested in high quality blue chip stocks, ideally dividend paying stocks. He died in 2014, made the front page of the Wall Street Journal, Forbes. Yeah, you name the financial press that's out there. Ronald Reid had his day in the sun, albeit he was 6 foot under. Okay, so why was that? Because Ronald Reid achieved what professional investors often fail to achieve. And what was that? Time and time in the market. So what he very simply did over his 80, 90 years on the planet is he invested, and then he invested, and he invested, and he let time do its job, which is the concept of compounding. And then obviously when he died at whatever age he was, in his 80s or 90s, nobody had a clue his net worth. Neighbors, friends, family, nobody had an idea that he was worth so much, and he willed the majority of his estate to good causes. So there's been things named after the guy as a result of that, and obviously I'm here this afternoon chatting about him. Okay, so what was the secret, and what can we learn? He saved consistently. He invested in what he understood. Okay, so that comes back to the education. He didn't invest in what he didn't understand. Okay, there's a lesson in that for everybody. He let compounding do its job. Okay, he didn't get scared when markets corrected, which I'm going to talk about as we go along here, because that is part of a financial independence plan. And he lived within his means. So again, loads of examples that I give there, and I will as we go along. Okay, and the beauty of this guy is he didn't have a degree, he didn't have a master's, and he certainly didn't have a PhD in financial mathematics or in investing. What did he have? He had good behavior. He had a good financial basis in terms of how he approached his finances, how he approached his investment. His behavior was literally what everybody should aim for. Okay, and to put it into context, what he achieved when he died, when his net worth was over $8 million, he would have been in the top 1%. In fact, he probably would have been in the top 1% of the 1% in net worth when he died. And it was purely based on his investing psychology and the time that he allowed the money to invest over. Okay. He couldn't, for example, have picked up a golf club. He couldn't have become Tiger Woods. He wouldn't have been in a position to fly an airplane. So if we had hopped in on a jumbo jet with a transatlantic flight and Ronald Reid was behind the controls, he sure as hell would have been concerned. And why am I giving that analogy? Because the guy achieved something in the financial world, as in he was on par with, if not greater than, the investment professionals who spend their entire lifetime working in the markets and working in the financial world. He was able to achieve and outperform the majority of them, whereas he wouldn't have been able to do that in pretty much any other profession. Okay, and that's the beauty of finance. Anybody can do it, given the right basis, the right psychology, and time. Okay, so that's the message there. So if you're sitting there thinking, I can't do this, this is impossible, of course it's possible. Okay, so what can you learn from, again, what can we learn from him? What I've just said already is behavior is more important than intelligence. Okay, so there's a quote there from Morgan Housel from The Psychology of Money. If you haven't picked up the book, I would recommend you pick it up. It's a fabulous read. New York Times bestseller. He only wrote it last year, and it's already one of the top financial books ever written. You're not going to learn an awful lot from a financial point of view, but by God, you're going to learn an awful lot from a psychological point of view, the psychology of how we approach our savings and our investing and our money decisions in general. And for those of you that are at nothing this evening, I'll put up a post at the end. We have a seminar tonight, and yours truly is going to be interviewing Morgan. So I've got a 40-minute interview with Morgan Housel tonight in relation to his book and many other things we're going to discuss. So it's a Smart Money series, and I think the tickets they're still available there. It's an online thing. I think they're €35 a pop. So I'll put the post up, or if Dylan wants to put it up there in the chat for me. It's something that might be of interest to you. Okay, and it's not just me talking to him tonight. There's Peter Brown is going to be talking about the current state of the economy. Tomorrow night we have a guy called Peter Townsend talking about cryptocurrencies, and Peter is non-exec director of Coinbase. It's the company that just listed on the stock exchange last week or earlier this month. Okay, yeah, Dylan's just put up the post there. Okay, so you can look at that later. Okay, so Another example is Grace Groener. Grace, same thing, not as financially active as Ronald was, but Grace achieved a net worth of 7 million upon her deathbed. And again, there's foundations set up after this lady. She willed her money to an education institute. So again, an example of a lady who invested over time, let money do its thing, and at the end of her lifetime was worth 7 million. Okay. And then our friend Warren Buffett, this stat, when I read it and I went from more than one location, one source to confirm it, Warren Buffett has accumulated over 99% of his wealth since his 52nd birthday. Okay. So just to put it into context, there's a man who is given his investing time. Okay. So now he's worth something over 80 billion or upwards of 100 billion. But 99% of that has come since his 52nd birthday. So that's the power of compounding when it comes to even the one of the richest men in the world. Okay. Let's contradict that or counteract that with Richard Fusco, who is still alive. He didn't go the way of a lot of these people who come a cropper to the financial markets. He didn't jump off a bridge or look down the end of a barrel of a gun. I know I'm being crude here, and I hope I'm not affecting or insulting anyone. But what you tend to read about individuals where they take the risks in their finances and things come to a poor end, that tends to be the end that happens. Okay, but Richard was a Merrill Lynch executive, the complete opposite of Grace or Ronald. He was a high-flying executive, Harvard educated, MBA, you name it, your letters coming after his name. So successful, in fact, that he retired when he was 40. Okay, so more money than sense, some people might say. But he was, traded. He was educated in the way of finance, so he knew. Let's put it in inverted commas. He knew what he was at. So why did Richard not continue to achieve financial independence? Because it's one thing achieving financial independence; it's another thing remaining financially independent. So it takes commitment, it takes education, and it takes frugality. It takes a little bit of fear of loss. All of that goes into the pot. And let's just say our friend Richard maybe didn't achieve with such a similar level of success as the three previously mentioned individuals. What happened with Richard is Richard ended up going bankrupt in 2010 in the middle of the last financial crisis. So there was a significant speed bump in the markets at the time. You'll all remember it, I'm sure. And Richard was one of those individuals that was caught in his boxer shorts when the tide went out. Okay. So what was his problem was he was over leveraged. He was living above his means, and it didn't end well in terms of his career. I believe he's reinvented himself since, because if there's one thing in America, it's you can go bankrupt and you can restart your career. And I believe the guy who had retired at 40 had to restart it all again in the world of finance. So I'm sure there's plenty of people out there who are silly enough to say, you know what, let's give him another crack and give him more money and see what he can achieve. So what can we learn from all of those examples? But Richard in this example is the exact same thing, is that behavior is more important than intelligence. So you could look at the two individuals. If I put both of them on the table in front of you and says, here's Richard and here's Ronald, give me their profile, you're going to say all day, every day that Richard is the guy with the deep pockets, when in fact it's the opposite. Okay, so he was leveraged to the neck, and that is often what you find, and we see it with clients. They're living a different life because underneath the water or underneath the surface, they have a significant amount of debt and a significant amount of leverage, which isn't a good thing if the investments or whatever it is that they're chasing, if it doesn't work out. So that's the risk appetite that there's a trade-off there in terms of risk and reward. Okay, so what else is relevant there? In relation to examples, you can use Jordan Belfort. You'll have watched the movie Wolf of Wall Street, or you might have heard of it. If nothing else, it's an interesting case study in terms of obviously illegal activity, fraud, the appeal of money, really, and how it all went wrong for what would have been a large company at the time. Okay, so where does that lead me on to then? So what we're trying to explain there is case studies, so that you can, are you going to become a Ronald Reed? Probably not. Are you going to become a Grace? Are you going to become a Warren Buffett? No, very, very unlikely. It's just what it is for you. And the fact that you can pull on these experiences and these examples to say, well, okay, what do I have to be doing in small steps to achieve some percentage of that success. Okay, and part of that is learning to pay the price. So what do I mean by learning to pay the price? Let me give you the analogy of the case study. So I want to buy a car, and I don't want to buy any car. Full disclosure, I drive a 2012 Skoda Superb Estate, and I'm very hesitant to upgrade it because I have 3 kids under 7 and under 8, and there's more scratches on that car than there is on the scratch card. So I don't want that to be repeated if I decided to upscale to another car, because then I'd be getting irritated and cross about something that I shouldn't really be getting irritated and cross about. But I have plenty of friends, neighbors, family, brothers who love their 4 wheels. Okay, so let's say I'm this person and I'm deciding to buy a car. I know if I'm going to buy that car, I have to pay a price for that car. So I'm either going to buy it with cash, I'm either going to buy it on finance, I'm going to take a loan from the bank, I'm going to buy it on PCP, take a loan from my parents, or I could steal it. So let's assume nobody listening goes for option number 3. Let's assume we go for option 1 or 2. So we buy it with cash, so we have it saved up in the credit union, or we divest our shares, or we take out an equity release on a property, whatever it is, and we go and we buy this car, or we have an inheritance or a bonus, and we decide, you know what, I'm going to buy the car, or with some PCP. Okay, we know it's coming with a price tag, so we know that that deal or that car is coming with a price tag. Okay, so you have to think the same way when it comes to investing. So what is the price, or what is the fee of investing? Okay, and I'm not talking about charges here. So that's a conversation for a complete other day. That would be something we discuss with you in the consultation that you may avail of. This is very simply the price of investing. Okay, the psychological price of investing. So how to get you to the table and look past the risks associated with investing. And the price with investing is literally volatility. So this is a snapshot of the same as in the index, the S&P, over the last 60 to 70 years. So you can see there, actually I think it's over the last 90 years. So you're looking at there, the S&P 500, it's been up and it's been down, and it's been up and it's been down, and it's currently up, and then last year was a gigantic pullback, 30% pullback. So up and down and up and down and up and down. Okay, so how did you react if you were one of the individuals that was invested, let's say, for the last 20 years? So what do you do? How do you react when that market pulls back 30%? And that's what paying the price is. So paying the fee of investing. And it's basically understanding what volatility is, because volatility is actually your friend. Okay, so I know this is counterintuitive for a lot of people, but what you actually want when you invest money is you want volatility. You want the asset to go up in value and to go down in value over a period of time. Why? Because generally over time, most asset classes, there are a few exceptions, but most asset classes will appreciate or increase at a particular interest rate over time. And that's where, when you have your pension fund at work, or you'll hear about a pension fund like, you know, Waterford Crystal pension fund going wallop, where there was potentially an overexposure to a particular asset class, and the timing was very poor in terms of how the pensioners were going to be paid from that pension fund compared with the investment strategy and, you know, the investment decisions that had been made. So it can backfire, and that is important, depending on the time frame. Okay, but if Waterford Wedgwood, if the Waterford Crystal pension fund had succeeded in riding through the downturn in the around 2010, I can only assume that, given where the markets are at today, it would be a pension fund in surplus. Okay, now there's no guarantees in that. It's all down to investment managers. And again, why is that relevant? Because if you're in a defined benefit pension scheme, and I'm just using it as an example here, if you're in a defined benefit pension scheme, you've got zero control over those investment decisions. It's done by a board of investment advisors, and then there's a trustees appointed by your company. So you hope that they're doing a good job. But in terms of your control, so where you can control your investing, is what you do with your own money. And understanding volatility means that you do understand that the potential returns are higher if there's greater risk. So you take on more risk, you have greater returns. Okay, I'm going to give examples. I owned Apple. I'm not embarrassed, and I'm not ashamed. I'm probably embarrassed to say that I owned Apple in the early noughties. I did get good value for money because I was able to travel the world for a year, didn't have to work, did volunteering, and was able to surf every day that I wanted to surf, and go anywhere I wanted to go, because I made a significant amount of money on Apple shares in the early noughties, which funded that. Now, if I had been a little bit more astute, maybe had a better mentor, a bit more long-term vision, if I had held Apple and just taken out a loan to do that, traveling around the world for a year, let's put it like this, I wouldn't be sitting here talking to you today. Okay, so but that's again experience. Look at Netflix in 2011. So what happened with Netflix in 2011? Netflix dropped 80%. Netflix dropped 80% literally in a matter of 6 to 8 weeks. When subscriber numbers dropped, it was looking like it's going to survive. And if you look at that drop in 2011 now on a chart of Netflix, you can't even see that drop. It's like a little blip in the chart. But at that time, if you zone in on it, it was an absolute cataclysmic drop in value, an 80% drop in value. So did you ride that through if you were a Netflix investor? Tesla, what can I say about our friend Elon Musk? He's an entertainer, if nothing else. So we love the tweets. But last year, 2019, Elon puts out a tweet. And if you're an investor in Tesla, he sends out a tweet saying that the stock is overvalued by 25%. What does the stock do? It sells off. You would be one pissed off investor in Tesla. But if you understand that that comes with investing in Tesla today, and if you survived through that 25% pullback, maybe even as an astute investor, you had cash sitting on the sidelines, you bought more, then you're smiling all the way to the bank today. Okay, even though Tesla, it was up as high as $900 a share, touching 900, it pulled back to just under 500. I don't know where it's at today. It's probably in around the 700 mark, 700s, but that's a significant increase. It's 10-fold, 15-fold in the last 12 to 18 months alone. Okay, so you're just trying to put it into context what volatility can look like at the time and how you react. It's how you react to that emotion and the thoughts that are going on in your head that you've got no control over, the chemicals that your body is releasing, the fight and flight concept, and nobody can actually tell you how you're going to react until you're actually in that scenario. Okay, personally speaking, when I'm invested in something and it's high risk, so cryptocurrency, which we get to, and I see a pullback in the market, I personally get excited. So that's the fight or flight. Why is that? Why do I see? Because I see it as a buying power. So I've just been given the opportunity to buy it at a discount. That's my modus operandi. That's my thought process when it comes to my investing. It isn't for everybody, but if you come and you're dealing with us, we would be on the higher end of risk when it comes to investing advice, so long as the individuals understand, caveat emptor, individuals understand the importance of time. We would certainly be of the mindset that taking more risk is better for you than taking less risk. And why is that? Because if you learn to like risk, if you can adopt and understand what role risk plays, it generally pays off over time. Okay, what's next? So hopefully that makes sense. Enough questions coming through so that either this is all making sense to you, you don't have any queries for me, or it's not making any sense. So let's hope it's the first, or I'm boring you to tears. Let's hope it's not that either. So in terms of what I'm never enough, so let's keep it going here. What do I mean by never enough? Again, we see it all the time. It's this concept of wealth versus envy. So I have X amount, or I'm paid Y amount. And in one of my previous careers, I worked in a sales management role, and by God, was the concept of envy there. And in fairness, we used it to drive on the sales guys. So we used it that, okay, well, John over there has just received a bonus of 25,000 euros or 30,000 euros. And we had no problem with advertising that to the sales team, which the idea there was to drive on the envy and it can be a good thing. Envy can be a good thing. So I'm not here to say that having that envy or having that drive, having that passion is bad. Absolutely not. I mean, I'm self-employed. Started the company 3 years ago with myself, Georgina and Jonathan, and there's 9 of us now. So, I'm not saying that that's driven by envy. It's driven by ambition as much as anything else. But the concept of envy when it comes to investing, it can work to your advantage, but it can also do some detrimental damage. Okay, and that's down to the psychology, and it's down to understanding. It's down to everything that I'm after covering over the last 15-20 minutes. So what do we mean by the concept of never enough, and where can it do its damage? Well, it's basically when you start comparing yourself with your peers. Social media, which I'm not a big user of, so no problem admitting it, even though we're doing these webinars and these talks through social media means, and a lot of the the attendees, even at tonight's event, is driven through social media. That's what the likes of Dylan and Ed do. So they're the guys who drive the social media activity. You know, that's where people are today. But you're comparing yourself to the Joneses. What are the people next door doing, while not realizing what their financial situation actually is? Okay, so sometimes what you don't do speaks more or speaks louder than what you do. Okay. Again, comparing yourself or thinking you never have enough can lead you to do foolish things. And what we mean by that, you take on too much debt, you go leveraged in the stock market. So let me use that Tesla stock as an example. So let's say you were investing in Tesla because it was going up and up and up, and you decided to leverage into the stock market and buy more Tesla. Leverage in the stock market means you borrow on margin from the broker that you have your stock with. So they lend you so you can buy twice as much stock, which is brilliant if the stock goes up, because then you get double the whammy on your money. But you're in deep doo-doo if the stock goes down. So, you know, if that tweet which caused Tesla to drop by 25%, if I was in a leveraged position in that stock, my portfolio isn't down 25%. My portfolio could be down 50 to 70%. Okay. And I had it with a couple of clients last year when the financial markets crashed. The markets only crashed 30% and they recovered within 4 months. Yet I have clients that still haven't recovered their positions because they were taking too much risk and or too much leverage with their portfolio. So self-administered pensions where they're making their own decisions. So they weren't clients that were availing of any of our investment advice, but the damage was done, and by God, it was done fast. What happens there is the broker just calls in, says you need to cover your shorts, you need to cover where you're at here, and then they automatically encash your position. So be very careful if you're looking at leverage when you invest in the stock market. Never enough, it could lead you to do something illegal. So again, not going to draw comparisons outside of, you know, I've touched on Jordan Belfort there. So obviously he was driven by illegal activity there among his colleagues. So, but it can, you see it all the time where you hear about something that went on. I mean, we had it in Ireland here with the banking crisis, with Anglo and with National Irish. Will it ever be resolved, or will their outcome ever be achieved? So it can lead you to do silly things. Okay. Moving on then. So what do I mean by crazy in the eye of the beholder? So again, let's just take me. Okay, so I'm the man in the middle. I'm looking around at my friends and my family, and I see one guy and he's just after buying a boat, a fantastic looking boat, brilliant looking boat. But I have no intentions, and never would I have any intentions of replicating what he does. But I'm looking on and I have my opinion on it. And then I look over the shoulder and I have a client, or I have somebody else who I know spends nothing, saves everything, doesn't invest. So they're the hoarder type of an individual. So what I see and what I think of those individuals is going to be unique to me. And why is it going to be unique to me? Because I have a particular philosophy, I have a particular psychology when it comes to finances. And each and every one of you listening here today, and if you're listening to the recording, will have your own philosophy when it comes to your finances. Okay, so what one person does might seem crazy to another. Why is that? Because we come from different households. We have different childhoods. So if I was born into a household with 2 teachers versus my best friend who was born into a household with 2 entrepreneurial parents, how do you think my outlook or my risk attitude would have been set from a very, very early age? So would I think differently than my friend because I was born in with teachers, you know, permanent, pensionable, secure jobs, government jobs, whereas my friend grew up in a household where his parents wheeled and dealed every day. So of course we're going to have different life experiences, and all of that feeds through to what our psychology is when it comes to making financial decisions. Education is another part. So we don't teach finance at school. We don't teach finance at college unless you opt to go to study a financial degree. And even what they teach isn't necessarily financial education. It's maths based, it's Excel based. They're not teaching people what we're covering here today. They're not teaching people how you value money, how you plan money. This isn't something that you can decide in secondary school. I don't want to study biology, I want to study financial education. It doesn't exist. Yet, my opinion obviously is that it should. Okay, so we all come from these different backgrounds. How does that impact our investing? Well, obviously, I've said it already. It impacts our investing because if you understand that my background is different to yours, and your background is different to your wife's, or your husband, which is an important point here, then you're less likely to try and copy them. You're less likely to try and replicate what they have achieved in the past or what they're trying to achieve. Because if you do try and copy somebody and it doesn't fit in with your appetite for risk, then it's only going to lead to failure. Because at the first, what we're going to call an outlier event, at the first blip, at the first outlier event that occurs, you're going to run for the hills. You're going to pack it up and you're going to say, crap, that wasn't for me. What in the name of Christ was I doing? And you're going to cut your losses and then you're out of the game. Okay. So when I say an outlier event, what do I mean? An outlier event was the financial crash last February. Okay. It was the financial crisis in 2008. It was the dot-com bubble in 2000. It was Black Monday in 1987, and repeating itself anytime that there's been a stock market correction where there's been a drop of over 30%. Okay. You tend to know about it because you read about it in the papers. It's on the front pages of every paper or online media. A war is an outlier event, so something that wasn't necessarily expected. Our little friend there, coronavirus, COVID, is an example of an outlier event. What do I mean? You can't really anticipate that they're going to happen until they happen. Okay, they generally come with a huge financial impact. Okay, so unemployment in Ireland went up by, was it 15% last year, and there's still somewhere north of 80,000 companies availing of the EWSS. That's a huge financial impact. Okay, and it tends to be unforeseeable. It's not something that you tend to be able to predict. Some people will, but they've been able to put a structure in place or an algorithm in place or in a learning in place that you can identify these things all the time. It doesn't exist. So that's why they're called outlier events. And the term used for these events tends to be black swan event. So again, you may or may not have heard of it. So why again is this important? Because if you're that individual that's investing through Symmetry or through Davy or through Goodbodies or through Cantor, and the market literally tanks, when it drops like a stone. And just using 2007 as an example, as opposed to 2020, when the stock market dropped in February 2020, the market was back at all-time highs by August. A lot of that was to do with quantitative easing, monetary policy. But back in 2008, 2007, when the stock market was at its peak and then it dropped to its bottom in 2009, early 2009, if you invest at the very top of the market in 07, the day it was at its highest price, and I'm using the S&P again, or the Dow Jones Industrial, whatever you want to use, if you invested at the peak of the market at that stage, you're still not back. So you weren't back at that level until 2012. So it took 3.5 years for the stock market to gain all of its losses from the financial crash of 2008. Okay, how you react to that, that's entirely up to how you've educated yourself, what behaviors you're bringing to the table, how you've structured your investment plan. Okay, and what time frame you're allocating. If your time frame happens to coincide with a financial crisis and a financial crash, you're a bit effed up, and to be honest with you. Whereas if your financial time frame is much wider and it goes well into the future, then it's just a blip on a chart. Okay, that's what we're trying to get across here. Same idea. You have this concept of people trying to time the market. So where you're basically trying to say, okay, well, we know markets are tanking. So if you sold out of your positions back in 2020 or in 2008 or in 2001, and you missed the best 4 days, I'm saying 4 days in that entire time frame, in that 20-year cycle, if you missed the best 4 days in the stock market over that 20-year period, your returns are 164 compared with 291% if you had remained within the S&P. Okay, so that's a fairly stark difference in terms of returning your money. And the reason why you missed it is you sold when you shouldn't have sold. Okay. The way you can avail or work around that is using unit price averaging, where you invest on the drip over a prolonged period of time. Now, it loses its effectiveness the longer you avail of it. But the reason why we like it is it gets you engaged, it gets you started, it gets you involved. And once you're involved, then you start to take an interest, you start to want to learn more, you start to want to educate yourself. And unit price averaging, where you're investing on the drip all the time, every time, means you're buying the highs, you're buying the lows, you're buying the highs, you're buying the lows. So last year, as a microcosm of an investment cycle, you would have bought in January and February, all-time highs. You would have bought in March, April, May, June, low, 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 low. July, it starts recovering. August we're back up. So you're buying at all of those price points. So the average in effect works to your favor over time. But more importantly, it allows you to get in. Okay, so it's about being prepared. It's about having a plan as opposed to trying to time the market. So very quickly then, talking about the role of cryptocurrency in this financial plan, this financial independence goal. Where does cryptocurrency come into it? It's an asset class. That's all it is. So treat it as an asset class. If you don't have exposure to it, you should look at having exposure to it. How much is entirely down to your risk appetite. You have Bitcoin, you have Ethereum. Listen, you have hundreds of these things, but the big players. Website called CoinGecko gives you the market capitalization on all of the coins. There's other websites as well, but the idea behind it is that you're using some of your hard-earned money, and you're diversifying into what is the newest asset class. And again, we're going to be talking a little bit about it later on tonight, and we're going to have Peter Townsend from Coinbase talking about it in greater detail tomorrow night. Okay, so obviously you have Ethereum and Bitcoin. Then you have Doge, which Elon Musk has been pumping with his tweets. If you aren't familiar with it, yeah, it's entertaining just to see what's been going on. Okay, so why is it potentially something to look at? Because there's volatility in it. So where there's volatility, there tends to be gain over time. Okay, so what do we mean by that? I'm not turning around and saying to you, take 10 grand out of your lifetime savings or sell stock and put it into cryptocurrency. Absolutely not. If you want to get your foot in the door, so to speak, and explore the concept of cryptocurrency, set up an account and unit cost average into the investments. So drop in 100 euros a month, and let's see, on a monthly basis, averaging in, let's see where that takes you over a 10-15 year period. Just be careful with security. Choosing a platform is important. I have accounts with Binance and crypto.com. Both of them are above board in terms of their performance, slow in terms of their customer service, but anyway, there's other platforms out there. Coinbase is another one, obviously. Store it securely, use two-factor authentication, and yeah, let's see where that takes you. And then finally, the 4% rule. This is basically the idea that if you want financial independence, how much do you have to achieve? So we've talked through how you go about it. This number is going to be different for everybody, but a rule of thumb is 4%, which is 25 times your expenses. So if you know what your expenses are, then you know you need 25 times that to be able to retire, or to be able to stop doing what you're doing and have more freedom and flexibility in what you do going forward. That doesn't mean you stop working. Absolutely not. It could mean that you do something else, something you've always wanted to do. Start a blog, run a coffee shop. I don't know. So I mean, there's hundreds and hundreds of ideas that you could do. The concept behind the 4% rule is you build up the pot, and 4% is deemed to be a safe withdrawal rate from a retirement investment. Okay, so from an investment fund, in that if you were taking 4% out, if you've invested, diversified, and invested it well, it should provide you with that 4% return year on year. It's not a one size fits all. Some people would argue 3%. It depends on what you're investing in. You get away with less. You get away with much less than 25 times your expenses. If, for example, you're invested in property and you've done that over a 15-20 year period, the return in terms of rental income can far outweigh the 4% rule. But just to put it into concept, if I wanted to have 100,000 euros in income when I retire, I need to have 2.5 million euros invested to give me that. Okay, that's just the rule of thumb. Okay, so about tonight then. So if you are interested, Dylan's put up the link there, the Smart Money series. We're going to be talking all things money. So a great lineup of speakers. It's 5:30 to 7:45. Yeah, 5:30 to 7:45. So it's 2.5 hours out of your evening tonight and tomorrow. You can drop in and drop out as you want. Morgan is speaking. The interview with Morgan is at 6 o'clock. I'm not sure what time Peter's talking at tomorrow. And I'm doing a webinar tomorrow night, a talk tomorrow night on property investing at the end. So that's the 7 o'clock. I've got the late shift tomorrow night on the webinar series. Okay. So in terms of a consultation, log on to our website, book a consultation, email us at symmetryfinancial.ie. If you have specific queries, put it in, as it helps us then guide the conversation, but consultation is there. No questions have come through, so let me just double check. Going to finish up pretty much bang on time. Yeah, no questions have come through. I give you 20 seconds there if anyone does have any questions. Otherwise, I hope that you take some of what we've covered in and put it into action. Thomas, good man, Thomas. Hopefully you put it all into action. Thomas, come back to us whenever you want. And yeah, thank you very much for listening in, and look forward to talking to you all individually in the coming days and weeks. Okay, thank you.